37% wipeout in 6 hours? With zero headlines, zero announcements, absolutely nothing. That's not market behavior. That's an orchestrated hit. Silver was sitting at $121 Friday at dawn. Then the floor disappeared. $75 by close. $46 vaporized in half a trading session. Gold plummeted from $5,600 down to $4,700. $900 erased. And here's what's bizarre. No conflict erupted overnight. No disease outbreak. No financial institution imploded. The news feeds were silent. Total quiet from every major outlet around the globe. You just watched the most violent single-session destruction in precious metals in years, and no one in the mainstream can explain why it occurred, except me. And once you see what I uncovered, you'll recognize why this pattern keeps repeating, why it unfolded in 1980, why it unfolded in 2011, and why it's guaranteed to unfold again. 3 episodes across 5 decades, identical blueprint, identical weapon, identical carnage. This isn't fringe speculation. This is verified historical record, and you're about to see it laid bare. Welcome to the Hidden Economy. If this is your first time here, I reveal what's actually unfolding in financial systems while the crowd fixates on surface noise. Subscribe immediately because this kind of forensic analysis doesn't exist anywhere else. And if this content delivers value, hit that like button hard. It pushes the algorithm to surface this in front of more eyes who desperately need it. Friday morning, January 30th. Final trading session of January, final session of the week. Silver rests at 121. January had delivered the strongest monthly performance for silver in decades. 65% gains in 30 calendar days. Sentiment was euphoric everywhere. Experts were projecting $200, even $300. Commentators were declaring, this is the generational move of a lifetime. Social platforms were ablaze with celebration. Everybody believed they had timed the entry perfectly. Everybody felt unstoppable. Then, 9:30 a.m. Eastern arrives. New York session opens. Within heartbeats, a tidal wave of sell orders engulfs the market. And these weren't mom-and-pop investors locking in modest gains. This was institutional scale. Enormous blocks, millions of ounces dumped in unison. The kind of synchronized liquidation that doesn't occur organically. Silver plunges from 121 to 115, then 110. Then it shatters through 100. That mythical psychological barrier everyone insisted was impenetrable. The support floor that was supposed to be bedrock. Gone. Obliterated in mere minutes. But the carnage didn't pause there. 95, 90, 85, 80. Stop-loss orders were detonating across the landscape. Margin call notices were flooding brokerage inboxes nationwide. Traders were being forced out, whether they consented or not. The machinery was liquidating them automatically. By session end, silver sat at 75. Gold rested at 4,700. 6 hours, 37%. Hundreds of billions in market capitalization simply deleted. I observed it live. I watched wealth annihilated. I watched years of accumulation turn to ash in hours. And the singular question reverberating tonight is straightforward. What triggered this? What shifted? The official explanation they fed you was nothing. Simply a correction, they claimed. Valuations ran too hot. Natural retracement. That's the narrative you're meant to swallow. Here's the actual sequence of events. Watch the 60 days preceding Friday. Pay meticulous attention to timing. December 12th. Silver is surging and capturing media attention everywhere. The CME Group, the exchange governing silver futures commerce, elevates margin requirements by 10%. It barely registers in coverage. December 29th. Silver continues climbing. Momentum hasn't faltered whatsoever. CME elevates margins again, and this time it's severe. A 25% spike overnight without advance notice. December 30th, the following day. Fewer than 24 hours afterward, they elevate margins yet again. 2 increases in 48 hours. That almost never materializes. January 28th, just 72 hours before the collapse. They execute it once more. This time, they restructure the entire framework, transitioning from fixed cash amounts to percentage-based requirements. 9% becomes 11. For elevated risk accounts, it climbs to 12.1. 4 margin escalations in 42 days. 80% cumulative elevation. Now here's what that concretely means for position holders. Margin is the capital you must maintain in your account to sustain a futures contract. It's your security deposit. When you purchase silver futures, you don't remit the complete value up front. You post a fraction. That's leverage in action. But when they escalate margin mandates, every trader holding exposure suddenly requires additional capital. Not next week, not at their convenience, instantly. Today, this hour. And if you're unable to inject that supplementary cash within hours, your holdings get liquidated. Sold. No discussion, no recourse, you're simply ejected. Imagine your landlord phoning you at this moment, demanding rent just doubled. And you have until midnight to comply or face immediate eviction. That's fundamentally the ultimatum issued to every silver speculator in the nation simultaneously. Your account demands 80% more collateral. Deposit it in hours, or we're closing you out. Most participants don't possess that liquidity readily accessible. They can't comply. So they're liquidated, compelled to exit whether they agree or resist. And when thousands of leveraged holders are compelled to liquidate simultaneously, what outcome do you anticipate for valuation? It doesn't merely decline, it implodes. It craters 37% in one session. This wasn't organic price discovery. This wasn't speculative excess naturally deflating. This wasn't orderly profit realization. This was the CME executing a mechanism. And here's what should genuinely alarm you. They've activated this identical mechanism previously. 1980. Silver rockets from $6 straight to $50, an 800% surge in months. Ordinary citizens are accumulating serious wealth. The establishment faces pressure. What was the countermeasure? The CME implements something labeled Silver Rule 7, which effectively prohibits leverage purchases overnight. You desire silver? Acceptable, but you remit 100% cash, zero margin permitted. In that identical month, the Federal Reserve Chairman elevates interest rates from 11 to 20% in one decision. The outcome? Silver crashes from 50 straight to 10, 80% annihilation. Finished. 2011. Silver runs from 8 to 50, a 600% rally. Retail speculators are flooding in from everywhere. Banking institutions with gigantic short exposures are suffering catastrophic losses. What was the countermeasure? The CME elevates margin mandates 5 times in 9 days. 5 adjustments in 9 trading days. That's an 84% escalation. The outcome? Silver crashes from 50 to 26, 50% obliterated in weeks. And it required 13 years for silver to reclaim that level. Now, here we stand in 2026. Silver climbs from 26 to 121, a 450% rally, the most explosive advance in contemporary history. What was the countermeasure? CME elevates margins 4 times in 42 days. The outcome? Silver crashes 37% in one session, the swiftest destruction of the trio. 1980, 2011, 2026, 3 occurrences across 50 years. Identical construction, identical instrument, identical devastation. Every single instance silver threatens genuine breakout. Every single instance, regular individuals begin accumulating tangible wealth in hard assets. Every single instance, gold and silver begin revealing the fragility of the fiat architecture. The exact identical strategy deploys. This is not coincidence. This is not prudent oversight. This is architecture, a system, something they activate whenever silver gains excessive momentum. Once is happenstance, twice is coincidence, 3 times is deliberate design. So the question that genuinely matters is motivation. Why does someone invest this intensity in suppressing silver? And the explanation has zero connection to silver in isolation. It has absolute connection to what silver symbolizes, what it jeopardizes, what it reveals. This concerns the dollar. The United States commands one advantage no other sovereign possesses: the global reserve currency. Every nation requires dollars to purchase energy, to conduct international commerce, to warehouse reserves in their monetary authorities. This is why America can manufacture trillions and persist. This is why they can accumulate 30 trillion in obligations and continue expenditures, because the planet has zero alternatives. Everyone requires dollars. Everyone must engage in the American monetary apparatus, whether they embrace it or resist. But something is transforming, and it's accelerating rapidly. Central monetary authorities worldwide acquired 800 metric tons of gold last year. Not dollar instruments, not government debt, physical gold, tangible metal they can custody in secured facilities. In January exclusively, central institutions offloaded $48 billion in U.S. government securities. $48 billion in 30 days. The dollar's portion of international reserves just declined to 58%. That's the lowest reading since 1995. 3 decades of erosion, and now it's intensifying. But here's the figure that should genuinely terrify policymakers. For the first occasion in modern history, gold now constitutes a larger fraction of central bank holdings than American Treasury obligations. Central banks globally now place greater confidence in a metal than they place in America's commitment to honor debt. That's not incremental drift. That's foundational fracture. And who's orchestrating this transformation? China, Russia, India, Brazil, South Africa, the BRICS coalition. They're constructing payment infrastructure that completely circumvents the dollar. They're clearing commerce in their domestic currencies. They're accumulating gold as if their sovereignty depends on it, because it does. Now observe what else China is executing. China commands 60 to 70% of worldwide silver refining capacity. Not extraction, refining. They're the processing gateway. Silver gets extracted in Peru, in Mexico, in Australia, but it all flows through Chinese facilities. Without Chinese refineries, the entire planetary silver supply architecture collapses. But silver is merely the opening. China processes 90% of the planet's rare earth materials. The components in your smartphone, your computer, your electric vehicle, your defense systems, 90% flows through China. They command 98% of gallium refining. Gallium is indispensable for semiconductors. They command 80% of cobalt processing. That feeds every lithium battery, every electric vehicle. They command 60% of lithium refining. The entire renewable transformation depends on lithium. The contemporary economy flows through Chinese processing infrastructure. Every technology component you utilize, every military capability your nation depends upon. And on January 1st of this year, China reclassified silver as a strategic national security commodity. They imposed export restrictions on it. Identical classification as military materials. Two superpowers with two completely opposing visions for global order. China desires a reality where physical resources command value, where metals possess genuine worth, where the nation commanding the processing infrastructure wields the influence. They invested 3 decades constructing precisely that positioning, and now they're deploying it. America desires the inverse. America requires metals to remain suppressed. They require gold to remain docile. They require your capital parked in dollars and government bonds and instruments they can monitor and regulate. Because if silver climbs to 500, what message does that broadcast about the dollar? If gold reaches 10,000, what signal does that transmit globally? It declares the paper has failed. It declares 50 years of monetary expansion has finally reached consequences. It declares the arrangement is finished. That message cannot be permitted to propagate, so they crush silver. Identical methodology they deployed in 1980, identical methodology they deployed in 2011. Margin escalations, compelled liquidation, valuation, annihilation. Meanwhile, China continues purchasing the physical commodity. They continue draining the repositories. They continue accumulating while the West panics and liquidates. This is not market administration. This is monetary conflict between hemispheres. Paper versus tangible, dollar versus commodities. And on Friday, you observed a skirmish in that conflict unfold in real time. The dollar itself communicates the identical narrative. The dollar index had been declining for months, descending from 110 straight to 95.55, a 4-year trough, the weakest dollar since 2022. And when the dollar declines, gold and silver ascend. The mechanism is elementary. Metals are denominated in dollars internationally. When the dollar weakens, it requires additional dollars to acquire the identical ounce of gold or silver. Plus, a declining dollar signals that confidence is evaporating in paper currency. So, capital flees to tangible reserves. That's why dollar weakness has consistently been propellant for precious metals. But something pivotal occurred at 95. Precisely at that 4-year trough, the dollar ceased declining. It located a foundation and initiated reversal. It's now ascending back upward, and metals crashed at that precise, identical instant. You believe that's coincidence? The dollar locates its foundation, initiates reversal, and silver surrenders 37% on the exact identical day. The margin escalations generated the forced liquidation. The forced liquidation crashed the valuation, and the dollar reversal provided everyone a convenient explanation. Oh, observe, metals were simply overextended. The dollar's recovering now. Everything is normalized. This was coordination, the apparatus defending itself on multiple fronts simultaneously. Now examine what's transpiring in the physical silver marketplace. Before Friday's collapse, when silver was still trading at 121, mints worldwide were already struggling to satisfy demand. Perth Mint in Australia had suspended wholesale contracts because the backlog was unmanageable. They simply couldn't fulfill the demand. The US Mint had halted Silver Eagle production. Dealers were defaulting on commitments. The valuation was at 121 and you still couldn't acquire physical silver easily. Now the valuation is 75. Attempt purchasing announced today. Contact your dealer. Inspect the online retailers. Observe what kind of premium they're charging above the spot valuation. Observe if they even possess any inventory whatsoever. The paper valuation declares 75, but the physical marketplace is communicating a completely different reality because paper silver and physical silver are not the identical thing. Friday demonstrated that beyond any dispute. Paper can be manufactured with a keystroke. Paper can be crushed with margin escalations. Paper can be manipulated anytime they select. They command the exchanges. They command the regulations. They command the entire apparatus. But physical silver cannot be manufactured. It cannot be margin called. It exists in the tangible realm completely independent of their command. When you custody physical silver in your possession, nobody can margin call it away from you. Nobody can alter the regulations overnight and compel you to liquidate. It's yours. 2 marketplaces, 2 valuations, 2 realities that are diverging increasingly every single day. While America was panic liquidating on Friday, and while speculators were getting obliterated left and right, While the paper valuation was crashing 37%, China was acquiring. Shanghai repositories drained 27 metric tons of silver in one session last week. Not sold on the exchange, extracted from the vault. Physical delivery to purchasers who desired the actual metal in their custody. This has been materializing for months now. While Western participants trade paper contracts back and forth, Chinese purchasers continue taking physical delivery. The repositories continue draining. The metal continues migrating eastward. America dumps paper contracts. China takes delivery of actual metal. America crashes the valuation. China responds. Gratitude for the discount. One side is trading commitments and obligations on computer terminals. The other side is loading transport with actual ingots of silver. Which side do you believe genuinely comprehends what silver is valued? Which side is executing the long-term strategy here? The fundamentals didn't transform on Friday, not one fraction. Silver has existed in a supply shortage for 5 consecutive years now. Every single year since 2021, more silver has been consumed than extracted. The cumulative shortage is exceeding 800 million ounces. That's nearly a complete year of worldwide mine output that simply doesn't exist. Industrial consumption is exploding. Solar arrays, electric vehicles, electronics, artificial intelligence data centers, military apparatus, they all demand silver, and that consumption expands every single year. It's accelerating. Meanwhile, supply cannot maintain pace. There have been 0 major new silver discoveries in years. Ore quality is declining at existing operations. It requires a decade to bring a new extraction site online, even if you locate silver today. Extraction costs continue ascending. It's becoming harder and more expensive to extract silver from the earth. Consumption ascending, supply constrained, shortage expanding. None of that transformed because of one crash. The shortage is still present. The consumption is still expanding. The supply is still constrained. The fundamentals didn't blink. What transformed on Friday is a paper valuation, a figure on a terminal, a figure that is commanded by futures contracts and margin mandates. Paper valuations can be manipulated. Physical supply and consumption cannot. After the 1980 crash, silver eventually recovered. After 2011, silver eventually recovered. Both instances, it proceeded to establish new peaks. They can suppress valuations. They possess the instruments to execute it, but they cannot execute it indefinitely. Eventually, physical reality prevails. It always does. You simply cannot fabricate supply and consumption indefinitely. The question is timing, and nobody possesses that answer. Not me, not anyone. Here's what I know with certainty. The CME elevated margins 4 times in 42 days, and silver crashed 37% in the final week of that sequence. This exact identical pattern has materialized twice previously in the last 50 years. Both occasions, silver eventually recovered. China commands most of the planet's silver refining, and they just implemented export restrictions on it. Meanwhile, America crashed the paper valuation. Central monetary authorities worldwide are offloading U.S. government securities and acquiring gold at the fastest velocity we've witnessed in decades. The physical marketplace was already fractured before Friday. Now it's even worse. The disparity between paper valuations and physical availability is wider than I've ever witnessed it. What I do not know is whether 75 is the foundation. Could silver descend to 50? Yes, it absolutely could. Could it rebound to 100 next month? That's also plausible. Nobody knows with certainty. And anyone proclaiming certainty right now is either deceiving you or attempting to sell you something. But here's what persists with me. If silver genuinely doesn't matter, why do they continue executing this? Why deploy the exact identical blueprint 3 times in 50 years? Why coordinate margin escalations precisely before collapses? Why does the CME invest so much intensity in the valuation of a metal? They claim it's risk administration. They claim it's for marketplace stability. They claim they're protecting participants. But examine what occurred on Friday. Participants got absolutely annihilated. Billions in losses, accounts completely obliterated, years of gains evaporated in hours. They're not protecting participants. They're protecting something else entirely. The dollar, the apparatus, the narrative that paper currency actually functions. The fact that they continue executing this, the fact that 3 times in 50 years they have crushed silver whenever it initiated genuine momentum, the fact that they simply cannot permit it to trade freely, that communicates to you exactly what silver jeopardizes and exactly what they fear. In 1980, they informed you they crushed silver to halt manipulation. In 2011, they informed you they elevated margins to ensure marketplace stability. In 2026, they're going to inform you this was simply a healthy retracement. Normal marketplace behavior, nothing to investigate here. But you can observe the pattern now. The margin escalations, the coordination, 1980, 2011. Now, China accumulating while America liquidates. Central banks selecting gold over treasury obligations. You recognize what they do not desire you to recognize? The paper valuation declares silver as 75. But paper is simply a claim, a commitment, an obligation that can be manipulated, margin escalated, or defaulted on at any instant. Metal is tangible. It exists in the physical realm. It cannot be manufactured by a monetary authority. It cannot be hacked. It cannot be frozen by any government. It cannot be margin called out of your custody. They can crash the paper valuation. They cannot crash the metal itself. They can liquidate futures contracts. They cannot liquidate physical silver residing in your security. They can manipulate marketplaces, but they cannot manipulate reality indefinitely. They continue manufacturing trillions. Silver cannot be manufactured. One of those must prevail in the end, and history has already cast its vote on which one. A multitude of voices are going to instruct you to liquidate now. Sever your losses. Exit while you still possess opportunity. And perhaps they're correct in the short interval. Silver could definitely descend lower from here. I genuinely do not know what materializes next, but ask yourself this question. If silver was genuinely worthless, if gold was simply some antiquated artifact, if precious metals were genuinely irrelevant in the contemporary financial apparatus, why would they require to execute all this? Why elevate margins 4 times in 42 days? Why deploy the exact identical blueprint across 50 years? Why would China be stockpiling physical metal while America crashes the paper valuation? You don't combat this intensely against something that doesn't matter. The intensity of the assault communicates to you the value of the objective. Remember that when you're formulating your decisions. Friday was not a crash. It was a transmission, a reminder of who commands the paper marketplaces, a demonstration of authority. But it was also something else. It was confirmation. Confirmation that silver still matters, that precious metals still jeopardize the apparatus, that after 50 years of fiat currency and unlimited manufacturing, they still have not determined how to render gold and silver irrelevant. And honestly, that might be the most encouraging signal of all. They labeled it a crash. I label it a crime scene. They labeled it volatility. I label it the same blueprint executing for the third occurrence. They labeled it risk administration. I label it the apparatus communicating to you exactly what it fears. 37% in one session, 0 headlines, 0 explanation. Now you recognize the motivation. The margin escalations, the blueprint from 80 and 2011, China versus America, paper versus metal, a monetary conflict that nobody discusses. The data is accessible. The dates are documented. The pattern is present for anyone willing to examine. What you execute with this intelligence is entirely your decision. This is the hidden economy. If this investigation opened your eyes, smash that like button for John CV, and let's keep exposing what they don't want you to see. Drop a comment below with your thoughts. Are you holding or folding?